All right, it's a minute after, so why don't we get started? Thank you for joining today's webinar on insurance products for pension funds, protecting participants, staff, and trustees. My name is Hank Kim, and I'm NCPERS Executive Director. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. For more than 50 years, NCPERS has teamed with Gallagher to provide our members insurance products that help pension funds achieve their missions and provide participants and their families additional security and peace of mind. In today's webinar, we'll provide an overview of the available products, share insights into the cybersecurity landscape, and provide an overview of the benefits most important to employees. Leading our session today are Sean Atkins and Zach Kramer. Sean joined Gallagher in April 2006. He has over 25 years of experience in employee benefit consulting, hospital administration, and financial management with large national insurance companies. Most of Sean's work has been with large governmental entities. Zach began his career at Hub International in 2013 as a retail insurance agent. And in 2022, Zach was promoted to Area Vice President at Gallagher. Though cyber is his niche, Zach has expanded into other areas of management liability, including D&O, EPL, and fiduciary. We do encourage audience participation, so please submit your questions by using the Q&A function on this platform. Your questions will be answered near the end of the session. So with that, Sean, Zach, let me turn the webinar over to you.
Thank you very much. Really do appreciate it. And thank you, everybody, for the opportunity to speak today. I'm going to jump over here to the agenda. The goal and objective today, obviously, we did introductions just a few minutes ago. I'm going to kick things off with a couple of our products here, which are the life insurance and the identity theft insurance. Then I'll be kicking it over to Zach, who will be closing out with fiduciary and cyber insurance. The majority of today's discussion probably will be focusing a little bit more on the cyber insurance because it is a pretty hot topic right now, as most people realize. But we wanted to make sure that we covered all the products that we currently support for NCPERS, both the plan administrators as well as the members, as we look to find ways to complement and collaborate with the overall goals and missions of NCPERS. To that end, I'm going to jump over to the life insurance and the identity theft insurance, and the way that this is really broken out. The first two product lines that we'll be talking about today, they're really focused in on the member level. So the life insurance is for the member, the identity theft insurance is for the member, whereas what Zach's going to be covering on the fiduciary and cyber insurance is really more at the at the trust level, the retirement system level, or the plan level, to protect the overall kind of structure of the program and how it's being delivered. So they are two little bit different avenues from which we have support there to help lend the benefits to NCPERS and provide some protection to everyone. So without further ado, I'm going to jump over to the life insurance side of this. The plan objectives of the life insurance is it's a decreasing term benefit. And it's really meant to complement a member's pension benefit. And if you look over here on the right-hand side of the graph there, you'll see that over time, when somebody starts out their career with a public sector institution, they don't have much in their pension at all that's accumulated just yet. So what this does in the life insurance is it pays a really big upfront benefit right at the front of somebody's career, and then decreases over time. And the reason for that is the pension starts going up over time, and at some point kind of hits that equilibrium point. But it's really meant to complement that pension, and that's why we've constructed it this way. We've had it in place for a number of years. It is incredibly unique because it does create a benefit for all members in the household. So not only the employee, but also for the spouse and for the child as well. There's nothing that has to be done on the member's behalf in order to add the spouse or the child. It happens automatically. It's just one of those nice little features of this product and what makes it so unique. Benefits are provided throughout the career and even into retirement. The only caveat is that you cannot buy this in retirement. You have to move it from active status into retirement status, so somebody can keep it for their entire career and then ultimately up into retirement. And then one of the other really unique features about this benefit is that it does provide additional benefits if you are severely injured or potentially killed in an accident, and that includes both on the job for public safety as well. So again, it's a very unique benefit. Again, the purpose of it is to complement the member's pension benefit. In terms of the plan features itself, the plan pays up to $225,000 in life insurance. There is a schedule that we'll go through here on the next slide. There's an additional $100,000 of accidental death and dismemberment. That's when you have that serious accident. It could be like a car accident. Unfortunately, maybe somebody falling off of a ladder, become seriously hurt, or potentially death that might resolve. So there is some additional benefit there. There's the same premium regardless of somebody's age. It doesn't increase. Unlike traditional insurance, as you get older, typically for those 5-year age band increments, insurance tends to get a little bit more costly on the employer side. This stays the same regardless of how old somebody becomes. There is no evidence of insurability. There's no medical exams. No paramedics are showing up at anybody's house or anything like that. There's nothing like that. It's automatic coverage. There's a significant benefit, obviously, when you're younger. So again, that $225,000, $100,000 benefit does pay more on the upfront side, and then does decrease as someone gets older. But the unique feature of this is the premium doesn't change. Whereas in most typical insurance plans, the premium really jumps up commensurate with age if that face value doesn't change. As mentioned before, spouse and children, they're automatically covered, and this can be continued with no premium if somebody becomes disabled. We call that waiver of premium. That's automatically built into this. I mentioned before that coverage can continue into retirement as long as they've had coverage as an active member. And while there is no maximum age limitations on this, the benefit does reduce with age, and you'll see that on the next page. One thing we always want to make sure that we mention with this product, it's not meant to replace any life insurance coverages that may already in place. So an employer may offer, maybe up to $25,000, $50,000 in basic life insurance from the employer for all employees. There might be some supplemental insurances that are out there today as well. It's not meant to replace any of those. This is really meant to complement. And if somebody wants some additional life insurance, they can certainly implement this and put it in place, and it would sit right alongside your current coverages that you have today. So that's the plan features. And then on the next page here, benefit overview. You can see there, if somebody's less than 25 years, that's when the $225,000 would kick in. It does decrease over time. It does become much less of a benefit as somebody gets older. It turns into somewhat of a burial policy as somebody gets over age 65. And then you can see the dependent coverage there on the far right hand side as well. It starts out at 20,000, decreases as well for the spouse. The child remains consistent over time. So that's the benefit overview for the product. And then in terms of another unique feature here is the student loan benefits. And this is available for anybody that's under age 45. It's reimbursement up to $50,000 if somebody becomes totally disabled. And it's something that you don't see in a traditional life insurance policy. It's tied onto the accidental death and dismemberment benefits. NCPERS and Gallagher worked through this for a number of months, got this approved, and something we're real proud of, as many across the United States are still struggling with what to do with those student loans. Lastly, in terms of plan administration for the life insurance benefit, it's a single premium per month, regardless of age or status, active versus retiree. It's $17 a month. Super simple. We try to make this as simple as possible to roll out. Mentioned before, it does cover that entire household for that $17. It doesn't increase when you include both the spouses and children. It doesn't matter how many children, anything like that. There's nothing that the member has to do to have that spouse or child covered. And it's most effective, for administration and take up rate when we see payroll deduction while somebody's active, and then once they move into retirement, a pension deduction. That is the best way to roll this out. When we do this on an ACH, it can be done so on an ACH. We just don't see much of a take up rate in that regard. That being said, the fall or spring open enrollments for that guarantee issue. The guarantee issue, again, that just means that You don't have to do anything. There is, like we said before, there is no medical exams. There's no questions or anything like that that have to be answered. It's a simple short form in terms of an application. Just turn that back into HR, turn on that payroll deduction, and the member's covered, and it's taken care of. It can be featured, and we do encourage this to be put on in a benefit enrollment platform or benefit enrollment system. It can be done on a paper basis. There's a number of institutions that are still doing this on a paper basis, but we do like to see it electronic. It's just a more efficient way of rolling it out. And as we're working with that multi-generational workforce, the younger population does tend to see things in an electronic format versus a paper format. And then to help to communicate this, there's all sorts of videos, webinars, and various other communication materials that are available if somebody would like to roll this out and communicate it to their populations. Okay. Next, I'm going to jump over to the identity theft insurance, and again, this is an individual type product. This is not so much at the plan basis, although the plan can purchase it for everybody. The plan objectives of this really to safeguard a member and their family's personal information, their finances, and even devices. There's some technology support there as well for those online threats and scams that are popping up on a daily basis. Everybody's seen this in the news, and Zach's certainly going to be covering the cyber piece of this, at the plan level here a little bit more. But this is after the fact and kind of somewhat preemptive from an individual's perspective, because there's all kinds of breaches out there that can occur. The family benefits include adding 10 adults. There's no restrictions on this, and unlimited minor children. So if you take a family benefit, you certainly can get a lot of bang for your buck there if you jump on a family benefit. The benefit it is provided throughout career and even into retirement, and each adult member receives up to $5 million in insurance policy. And that's where I want to really kind of stop here. Is you kind of look at that infographic over there on the right hand side there. There's all kinds of losses in terms of digital crime, up to about $6.9 billion as being reported. It's much higher than the home burglary and losses that are out there. That $5 million goes a long way. Where we typically see, and you may see have been an unfortunate member that has seen some sort of a breach, maybe the Anthem breach or a Cigna breach on the medical side. There's been just numerous types of breaches out there, and I'm sure Zach will touch on some of those as we get through this. But this is what we typically see on a breach is somebody will come out with credit monitoring and just add it's Experian or Transamerica or something like that. This is actual insurance, and that insurance goes a long way in terms of providing coverage for a number of things. I mentioned before, it's up to $5 million. It will cover if somebody got into your retirement accounts, your investment accounts, maybe a deceased family member. They got out there and got some coverages. Another big one out there is home and title. Something we might think about, where maybe somebody had gone out there and put a lien up against your home, or maybe took out a second mortgage against your home, or maybe sold the home just straight out from underneath you, and many more things. Some of the other features of this, and that's just for the $5 million piece to help restore those things that might have been tapped into. But there's also credit monitoring alerts. Those are pretty standard blocking and tackling. So you go to a store or something like that, maybe you open a credit card, it'll send you over a text or an email, depending on how you have it set up, saying, hey, did you authorize this? There's also dark web monitoring. I did sign up for this for my daughter. Come to find out that there was I believe I'm saying this correctly, Chegg, CHEGG breach. And my daughter's information was actually out on the dark web. I was able to remove that. That's one of the hidden gems in identity theft right now is getting a hold of children's information, sitting on it until they become of age, 18 years or older, and then start opening up credit cards, and then they have all kinds of problems. So we were able to get that taken care of, which we were real happy about. Credit bank and account freeze assistance. If somebody breaches into something and you've got your information in there, they can reach out to those financial institutions, freeze your accounts, things of that nature, so nobody can get into them. So somewhat preemptive, so you're not having to tap into that insurance to restore yourself. Another big one out there, tax fraud prevention. A colleague of mine that was unfortunate a couple years ago actually experienced this, where somebody went out and filed his tax return on his behalf. Didn't take any of the there was no taxes, took out $60-some odd thousand. It was It was unreal. The stuff that was actually being reported, all kinds of credits and things that he had nothing to do with. But that being said, there is some tax fraud prevention out there as well as U.S. Postal Service address monitoring. If somebody went in and tried to transfer your or forward your information over to somebody else, forward your mail, it will stop that as well. Criminal court, public records monitoring, child social security monitoring, et cetera. So there's lots of things that are out there, as well as some technology at the bottom there that can also be utilized. So it gives a lot of protection. It's much more than just simple credit monitoring that you may be part of through a previous breach. Benefit overview here. There's actually two plans out there. There's Protection Plan, there's Protection Plus Plan. Those are the two primary plans that are out there. There's actually another plan out there that is getting a little bit of traction, but not a ton right now. The one we sell the most or been able to place the most is really the Protection Plan. It's kind of the basic core plan. Because it does do a lot. It's extremely powerful in terms of insurance. It provides a number of things we just mentioned here: privacy assistance, vault protection, password managers, ID, the IP address monitoring, all the way down to the credit monitoring and things of that nature we chatted about a few minutes ago, as well as the tax fraud prevention. It's not that the Protection Plus isn't a great product, but in terms for bang for the buck, the most members have found that Protection Plan has been very, very adequate for them. In terms of plan administration, it's super easy to implement. It can be implemented at the employer or the system paid. It can be done on a voluntary basis. So either the employer or the retirement system, they can pay for it themselves, or it can be on a voluntary basis, and then employees can choose whether or not to enroll or not enroll. The employer system rates, they do vary based off the size of the group, but if you were to roll this out on a voluntary basis, the Protection Plan, which is a very robust plan, it's $7.95 for the individual, and then $13.95 for the family. And again, that family coverage will cover up to 10 adults. So again, it's a great product on the family side, because you get to cover a lot of folks. It's most effective plan administration, again, just like the life insurance, as if it's on a payroll deduction while you're active, and then moving it over to a pension deduction once retired. But it also can be administered on an ACH basis or via credit card even. This one's a little bit more unique just because of the way it is set up. Enrollment on this, unlike the life insurance, which is at open enrollment or as a new hire, enrollment is continuous on this. So once it's implemented with a group, somebody can sign up at any time. And pre-existing events that are reported within 90 days of discovery, they still may be eligible for expense reimbursement, even though the incident occurred prior to them enrolling. That does happen from time to time, and sometimes that's when we see the most activity, is when there's a big breach. There's been a couple big breaches here over the past couple of years, and we do get some folks to reach out to us, say, hey, we've had a breach, we want to put this in place and roll this out immediately to our population. We simply let the carrier know, and the carrier then puts that in the notation into the system, and then they know how to underwrite it, et cetera, and we get that taken care of for folks. It can be featured and encouraged to be put on the benefit enrollment platform, just like on the life insurance side. That way it's very visible, and again, that electronic media, get it out in front of folks. And then there are a number of videos, webinars, and other various materials, communication materials out there that are out there to help educate and let members know what this product is. Okay. And with that, I'm going to turn this over to Zach, and he's going to close it out here with fiduciary and the cyber insurance.
Thanks, Sean. Appreciate that. A lot of good information, and it'll dovetail perfectly to the cyber insurance and some of the breaches that we talked about. So go ahead to the next slide. So I'm going to go a little bit over fiduciary insurance overview, why it's needed, what's covered, then I'll go on to the cyber. So why do pension plans need fiduciary insurance? Well, this is coverage for your fiduciary duty, your standard of care. Government entities are subject to a very high standard of care compared to other organizations, and they really cannot rely on the indemnification and the statutory indemnification that they're provided. With this, the fiduciary insurance will give them additional coverage. And then when you participate in a state employee retirement system, does not relieve the member of any fiduciary responsibilities. They still have the fiduciary responsibilities, and the standard of care is still high. There could be litigation with regards to that. And with these public employee retirement systems, they still have the responsibility for the non-defined benefit pension plans, your supplemental DC plans, such as a 401k, a 457 plan, any of your health and welfare plans. So all of these are part of your fiduciary responsibility. And then we have seen many lawsuits against the pension plans, and this is why they would need it. One of the benefits of the fiduciary policy is it protects against the personal liability against plan trustees and government officials for any losses occurring from a breach and for profits that were attained through misuse of plans. So this policy protects the plan and the individual fiduciaries of the plan. So this is, as Sean mentioned, this is specifically for the plans, not the individuals, and it was protect any of the decisions that are made at a plan level. Sean, you can go to the next slide. And so what does fiduciary insurance cover? There's a lot of insurance cover policies. There are a lot of companies that offer this coverage that are all slightly different. But the basis of the coverage is for any damages, defense costs, judgments, settlements, which the insureds are legally obligated to pay as a result of a claim that was committed or attempted as a wrongful act. So a wrongful act is a breach of duties imposed upon fiduciaries by an employment benefit law, any act or omission in administration of the plan. So this ultimately is if something happened during the plan and one of the members brought a claim against the plan, this would defend it. The most important thing about the insurance policy is the defense costs, because you start racking up costs right away to respond to the claim. And then once this claim has been litigated, there will be the indemnification. So this is your damages, your judgment, your settlement, which the policy will also pay that as well. With a fiduciary policy, most insurance companies have the duty to defend, and the insured has choice of counsel. Not all fiduciary policies, the insured has choice of counsel. They sometimes have mutual agreed counsel, where with the policy that the insurance company and the insured would have to agree. So not everything is covered under a fiduciary policy. We do see some typical exclusions. There are other exclusions on the policy, but these are the ones I always like to point out. One is the failure to collect contribution owed to the system or failure to fund the system. That's something that's not covered under a policy, because that's something you need to do is collect the contributions. Payments to the plan participants or beneficiary, investment losses. As the market goes, the fiduciary policy cannot cover the market, because if it was invested in the wrong item, and this is directly for the funds. This is directly for the monies. If there was a lawsuit out of your fiduciary duty that you invested in the wrong plans, or there was negligence, the policy would most likely respond for defense costs for that. Any type of fraud or criminal acts, this is something that's not, no insurance policy can cover fraud or criminal acts. And then any workers' comp law violations, this would be under workers' comp policy. Employment-related practices related matters, such as wrongful termination, discrimination, that would be under an employment practices liability policy. If that's something you guys don't have, you can reach out to your agent on that, or any bodily or property damage, because there's other policies for that as well. Sean, you can go ahead into the next slide. Cyber insurance. This is, I think, the hot topic right now. This is where I know I've dedicated my career and grown up in cyber, where there's not, in 2014 to 2018, there was a lot of new entrants to the cyber market. So a lot of our insureds, they didn't buy the coverage, but they started to buy the coverage. And now we're seeing what we're in actually a hard market. And I'll kind of go through a little bit of that later on where we are in the market. But the first thing I want to go over is what a cyber policy covers. every insurance company has slightly different policy language. So it's best to go over with your broker if you're not understanding them, because they're all slightly different. Really, the policies are broke out into first party coverage agreements and third party coverage agreements. So the third party coverage agreements, this is for any liability that you're faced out of a claim. So this is, privacy and network security liability if there was a lawsuit that came out of a breach, regulatory fines. So if there's any regulatory agencies that say you didn't notify correctly, or the duty of care. Payment card industry fines. This is if you're using credit cards incorrectly. Media liability. This is so if there's anything that you say you post on your website, or this is really for incidental media. If there was trademark, or you posted a picture that was trademarked that you didn't have the rights to, we are seeing some lawsuits out of that. Then I'll go to the first party piece. This is the most important part of the policy. And is where we see most of the claims. We've seen some liability claims. I would say the media claims are probably the most, but on the liability side, it's really class actions. There was a class action against Home Depot, Experian. Really, that's where we're seeing this. But with the first party costs, the most important thing is the incident response expenses. So I'll go through the life cycle a little bit in the next slide of what this covers. But with the policy, come with all insurance cyber policies comes a 24-hour breach hotline, where if there's anything that goes on and you're not sure what's happening, let's say you think it might be a breach, or there is a ransomware, I recommend calling the breach hotline as soon as possible, because what they will do is they act as a quarterback. They will say, you can call them and they'll say, you know what, this isn't really anything, or this is an actual breach. We need to bring in the vendors. And I'm going to go through that a little bit on the next slide, because I think that's really important. And then there's a cyber extortion coverage. And that is something that if there is ransomware, that is insurance agreement that would pay for this. Well, we see some policies that want to start sublimiting this. So this should be a full limit on the policy. Let's say if it's $1 million policy, we want to see $1 million cyber extortion, because this is where the claims are. If you don't have proper controls, we are seeing some insurance companies sublimit this. And I'll talk a little bit more on that. Business interruption laws, dependent business interruption. This is if you were held for ransomware and then your systems were down and you weren't able to do business. Digital asset restoration. This helps restore your all your assets, all your restorations, to help get you back to where you were. And then there's some additive coverages that we like to see on the policy. As the market has been pretty soft, we want to make sure that we have the broadest possible coverages. So contingent bodily injury and property damage, this is usually a sublimit on the policy. Reputational harm, if you were breached and you have lost income, you're not getting due to the reputation harm of the breach. Say you have clients say, we knew your breach, you lost our data, we're no longer going to work with you. Cyber crime, this is outside of ransomware. This is something that's really important, where I'm going to go through the claims, where we've seen a lot of cyber crime claims. And this is usually on a sublimit on the policy. It's either $100,000, or most carriers offer the max of $250,000. Sean, you can go to the next slide. So this is what I want to go through a little bit more. As I mentioned, the breach coach. And this is how the life cycle of we pick the insurance vendors when a breach happens. I will say it's the most important thing. I'm going to keep repeating that, because I know you guys might have been through a workers' comp claim. You might have been through a general liability claim, or even a property claim. But if you have not been through a cyber claim, you really don't know what to do. So having that breach coach as a benefit is the most important thing, because what they will do is once you call them, they will bring in the vendors that are needed. So if there's a ransomware event, they'll bring in a ransomware specialist. They'll bring in, if there is, they don't know if information was taken, they're bringing a forensics firm. And then once, let's say, information was taken, they'll then bring in notification as credit monitoring. As Sean mentioned, there was a check breach. His daughter might not have been notified correctly or get the correct credit monitoring. So it's good to have that on the individual level, but this is specifically for the plan. And then if there is a large breach and a call center needs to be set up, so all of your clients can call in, see what's going on, and then they bring in a public relations crisis management firm to help manage it. Because as a breach, there's a huge public relations and issue, and they want to help manage that as much as possible so there isn't a reputational loss on the back end. With also, if information is taken, then there's a privacy council that they bring in to help notify. And every state has different laws. So it's really beneficial to work with them, because if you don't buy the coverage, you may be working with a lawyer that doesn't always do cyber claims. And if they aren't notifying the clients as by state statute, some are within soon as practicable, some are within 48 hours, some are give a little bit longer, but every state has a different law. So they need to be able to do this. If they're not notified correctly, this is where you'll see a regulatory lawsuit or a class action lawsuit on the notification piece. And one thing with all of these vendors, they're pre-vetted. They're the same. The insurance companies pre-vet these, so they know what they're doing. They're handling a lot of cyber rates, and they're below market rates. If you go out and try to hire a breach coach outside of a cyber insurance policy, one, the big guys that are work with insurance companies that handle the most claims, they're not even available. They are so busy working on insurance company claims. They won't you just can't approach them to get them to work on your behalf. So you're working with maybe even the lower tier, and not saying that they're all not great, but they haven't handled the ones as many as with insurance companies. And I saw one the other day that it was $1,000 to hire them without an insurance company. But the insurance company rates were under $400. As I mentioned, they're tested, they're knowledgeable, they've handled a lot of claims, and then they have access to crypto wallets as well, because a lot of times where we see a ransomware claim, they're requesting Bitcoin. So they may say, we need 30 Bitcoin. As an insured, I don't think you guys would have a Bitcoin wallet to pay the bad actor. So they'll bring in a vendor to help them do that as well. Sean, you can go to the next slide, please. So now I'm going to talk about just current trends in the cyber marketplace. It's really about the claims. As I mentioned in, say, 2014 to 2018, where a lot of our insureds started to actually purchase cyber insurance, there wasn't a lot of claims. There wasn't a lot of questions asked. I'll go through the controls. But as 2018, everybody started working from home, and then COVID hit, where there's a lot of bad actors that were surfing the web to see where they can get in. So most of where we're seeing the claims is fraudulent payment and social engineering. That is transferring money. So let's say a bad actor has been in your system watching how you guys move money around. They'll just sit behind the scenes for weeks before they actually do anything. They may wait for somebody to be out of the office or something that's rushed. And what they'll do is they'll send an email and say, hey, pay this right away, and just change the wire instruction number. And at the same time, when the response, they even ask if it's valid or this, they will create a folder within that client's email box or the breached email box and set a rule. So even that person, if they're working or out of the office, that email will automatically go into a different email box, and they will respond with the bad actor, and they won't even know they're communicating them because of how they set rules. So that's why we see it sublimited with a lot of cyber insurance policies, because the losses are frequent. And we saw one the other day that they transferred $600,000. We are starting to see there are sometimes we can get higher limits, but we would have to write excess policies over your current carrier. And then we're going to go to ransomware claims. Ransomware has been everywhere in the news. I'm sure everybody has heard, the big breaches, the CNA breach, the MGM breach that just happened. And as Sean, thanks for switching that. These are the payments that we saw. The largest demand in 2021 was $60 million. The largest ransom paid in 21 was 5.5 million. The average ransom was right over 500,000. And then, so we're seeing these, I would say, in about this last year, they're trending the frequencies down a little bit. And then we're not always paying as many ransoms because when I go to the next slide, is information's getting taken. And Sean, actually, go back real quick. I want to finish that slide. Sorry, I jumped ahead. So a lot of times you're down for 11 days. So that from demand to payment to when you get the key, you're down for 11 days. So if you weren't able to do anything, there could be a business interruption loss. And then it's actually the higher the ransomware, the quicker it's paid. So over $1 million is 9.8 days. And then for payments from 200,000 to $1 million is 13 days. And then from encryption to restoration is 12.2 days. So ultimately, this is you're down an average of 12 days before you actually get back to even. And then once this happens, you have to do forensics and you have to work on everything to see if the information was taken and then notify. Sean, the next slide, please. And this slide's all about data exfiltration. So 80% of the time, an organization was able to fully back up without paying a ransom. This is actually huge. Invest in your backups because if you are held for ransom and you can back up to yesterday and not lose any information, then you don't have to pay the ransom. They will probably still release the information. And what we're seeing is with some of the ransoms paid right now that they're releasing the information anyways. So that's something, it depends on the strain of ransomware, the bad actor. And a lot of these vendors that have going to release
Hey, Zach, can you
also,
repeat yourself? You just broke up for a little bit.
Oh, yes. So when paying a ransom, it's most important to restore from backups. So ultimately, investing in backups. And we're seeing a lot of times that even if you do pay the ransom, that the bad actors are actually releasing the information anyways. So then 82% of ransom nodes claim they have thefted data before they've even encrypted your data. 73% have found evidence of data exfiltration where there was claim in the theft and data in the ransom note. So at this point, there are 27% that said they have information, but they actually don't. And then 81% of ransomwares actually have to notify the individuals. So about 19%, they said they had the information, but they did not exfiltrate the data. 24% involved a payment to a threat actor group that even though they fully restored from a backup. There could be other reasons for this. This is to get the information back because maybe they would get the information and they actually did not exfiltrate the data. And Sean, you can go to the next slide now. So these are just some headlines. Ransomware we see in the news. CNA, which is an insurance company, they paid a $40 million after their March cyber attack. That's just the ransom alone. That's not any of their credit monitoring. That's not any of the business interruption. That's not any of the forensics. That number I heard was probably 4 times the ransom, and probably higher after the fact of the business interruption. Colonial Pipeline paid about $5 million. JBS paid $11 million. And these are just the ransomware payments. As I mentioned, there's all the rest of the costs. Capital One, their breach, they bought $400 million in limit, and they lost it all. That the whole tower, the whole insurance companies, every insurance company on that tower paid. So it's scary. There's headlines. So it's really, buying insurance, but also now buying the correct limits and not just having, it's great to have it, but are you insured correctly? Have you gone through, a lot of times what I'll do is I run a data breach cost calculator where if you had a data breach, how much would you pay just to do credit monitoring and to notify? and that doesn't even include the ransomware or the business interruption. Sean, you can go to the next, please. This is really where we're seeing ransomware by entity size. A lot of times I have clients say, we're not that large. We're not being hit by ransomware. We're not being hit by bad actors, but we're really seeing that they are targeting the small business space. Under 500 million in revenue is where most people have been hit. Because ultimately this is, as you're a larger insured, the better controls that you have. If you're a smaller insured, the bad actors are just cruising the internet and looking for open vulnerabilities, anybody without MFA, or maybe if the latest critical vulnerability has not been patched. So this is super important. If there's any critical vulnerabilities, any updates, update right away, and try to do it and have a process where you're updating a critical vulnerability within 1 to 3 days, because they're really looking to have these. Healthcare is a very large target because it's really about the amount of information you hold. The more information you hold, the higher of a target you are, because the more this is why the more credit monitoring you have to do. So if you have a lot of personal information, we see this in government, healthcare, business professional services. We see a lot. In 4% of the nonprofits, I read actually a lot of nonprofits, and you would think they're small, very small. We're seeing them being hit even as a larger target because they don't have the controls right now. So I would say, we're looking at about 50% of entities that are hit are below 100 million in revenue. So that's something I want to take away, because I know a lot of you guys aren't the huge entities. So that's where a lot of people are saying we don't need insurance. We're not going to get hit. Something I want to address. So next slide, please. So this is the shift in underwriting. This is something I think everybody has gone through over the past 4 years. Pre-2018, I kind of keep going back to that, before the claims happened, before COVID, it was really easy to get a cyber quote. Most carriers, you can get a cyber quote with your name, your revenue, or your operating budget. Do you have antivirus? Do you back up your data? And have you had any claims? That's it. That was all of the underwriting process that was needed. Most insurance companies, they really didn't care about anything else. There was no questions about MFA, EDR, which I'll go through that a little bit. So it was really easy. In the state you worked in, your class of business, you could get a quote. After COVID, after we see the change in the marketplace with a lot of claims, there are a lot of insurance companies that run third-party vulnerability scans. They really are digging into ransomware mitigation control. So this is your backup, as I mentioned, backups, because this is the most important thing. Your identity and access management, your patching. I mentioned this earlier. If you're not patching within usually a week or some, I saw somebody the other day that they say, oh, we'll patch in 2 months. Well, the insurance company didn't like that, because honestly, that's where the losses happen with the vulnerabilities. Your email authentication processes, this is where, you see external emails. They also care about multi-factor authentication. And then they're also wanting to see employee training and cybersecurity awareness, because employee training is huge. Outside of social engineering, then ransomware, it's privacy breaches due to just employees. I had a client the other day where actually it was around tax time, where they had a bad actor sent to a secretary and say, hey, we're working with your accountant. Can you send us all these W-2s? She sent 700 W-2s to a bad actor, and they were all filed, and the insurance company paid over $800,000. So training your employees, not phishing links, going through that is super important as well. And even if a carrier doesn't require it, it's something you should do as just a standard to help prevent the losses. Next slide, please. This is the controls I've talked about. These on this slide are critical, and almost every insurance company will not offer cyber coverage unless you have these in place. And I mentioned 3 years ago, nobody even asked these questions. A lot of my insureds didn't have them in place. They didn't even know what they were. The most important one is multi-factor authentication, or MFA. This is the dual authentication. This is, I'm sure you guys have with your bank. I'm sure you have it in place now, where you need a second authentication. So it's your cell phone. So hey, you need to put in this code. You need to accept this call. We're seeing a lot of, that's stopping a lot of breaches without multi-factor authentication. A lot of bad actors, they could log into your account from anywhere. If they had your credentials, they can log in, get in your system within minutes, and you would never know. So it's multi-factor authentication for employee email outside of the network. If you're on your network, you do not need MFA on email. The only time you need MFA when you're on network is for accounts that have privileged access. So this is domain admins, system admins, anywhere with elevated access. And this is required on and off for these just because the amount of access that they have. We've seen some bad actors get in and move laterally. They'll get in somebody without elevated access, and then they can move laterally in your network to somebody that has privileged access. And that's why it's required on as well. And I mentioned any type of remote access. If you use Citrix, if you use a VPN, if you use Microsoft's RDP, everybody will tell me, oh, I have VPN, it's secure. It's not. If you don't have multi-factor authentication on your VPN, it's not secure and something you need to get. Offsite backups, encrypted, cadence less than 7 days, 30 days minimum, and at least tested once a year. I've mentioned this will be the third time because I think it's super important, because without being able to back up to what you have, you've lost your information. Even if you could recreate it, you're never going to get it back completely. Next slide, please. And these are some more critical endpoint and detection and response solution. So an endpoint detection, or EDR is what it's also called, it's a software that'll monitor all of your endpoints. So if there is some type of activity, it'll alert you right away before a claim actually happens or before they get too far. So this helps in the process of monitoring. Create an audit plan for critical software and hardware. This is patching. Again, you need to have a written plan with this, because there are certain high-profile zero-day exploits, the Microsoft Exchange, Kaseya, Acelion. There's been multiple of these. As soon as these exploits are out there, bad actors are all over them and trying to exploit them. And then segmenting any end of life, end of use software systems. So this is something like, I'll use an example of, you're still running Windows 98 on one of your computers. It is no longer supported by Windows, and they aren't giving updates. So any updates, that security vulnerabilities, they're not pushing out updates. They're not updating it. And I know that's a little bit of an old example, but I know it's something everybody will understand, where if you're not updating, if your software is no longer supported, that's another thing where bad actors are looking and surfing the internet to see if you have this, and it's an easy way for them to get right into your system. Next slide, please. I talked about cybersecurity training again. This is super important. Phishing simulations that track performance, strong email filtering tools that block specific attachments. These, as you get larger, I would say these are 100% required for every insurance company, but they are definitely good to have. So the larger plans, these would be required, but I would say around 250 million in operating expenditures and above, these are required. A PAM tool to help your privileged access, an SEM tool that's managed by a 24-hour security operations center. So this is something I would say the larger ones. A lot of the smaller clients, they don't 100% need these items, but they are important to have if it's something you can do. Next slide, please. And this is, I just thought this was interesting. It's the 2019 speed to crack passwords. If you have an 8-character password, 3 minutes. How many here have used all of their personal passwords that are probably less than 8 characters if the a login allows it? How many times, I know myself, sometimes it's, you know what, I need at least 8 characters. That's not very secure. You think it can be cracked in 3 minutes? And as you get further up, 10 password, 10 characters, 1 week. 13, 5.2 million years. I think that's actually gone down a little bit since 2019. I was looking at an updated one the other day that I think it's more around a couple 100,000 years, because that's how fast everything's moved. So we see some of my larger organizations, they are moving to mandatory 15-character passwords. I know that's a pain on everybody. I know I personally don't like it, but I have that on all of my accounts because I've seen the hacks. I've seen the individual hacks. I've seen everything through. I get noticed of a breach, a ransomware event, a cyber deception event, probably 2 or 3 times a week for my clients. So something that I just wanted to kind of throw in here. I thought it was good information for everyone. And that's actually all I had. So if anybody has any questions for me on the fiduciary, on the cyber as well, or if anything for Sean, let us know.
Great, thank you, Zach. Yeah, we certainly have questions that came in earlier, but on that last note about passwords, what are the current thinking relative to biometrics? Like, obviously a lot of phones and computers use identification of your face. Is that still very secure, or is it not?
It is. It is still secure. You can use it, but as we progress in the technology, there is deep fake technology where they are starting to mimic your voice, mimic your face. If it's your device that you have in your hand, such as your iPhone, I think it's very secure. But if you're using it other things, I think it's starting to become less secure as technology advances.
Great, thank you for that. So we do encourage audience participation. Again, if you have any questions or follow-ups or comments, please post it in the Q&A function of this platform. We did get some questions before the session started, and they are, what additional insurances are needed outside of a typical cyber risk insurance policy?
So that would depend. Outside of cyber, for cyber specifically, having an insurance policy is something that I recommend that everybody has. Outside of a cyber insurance policy, I think Sean, I could, the policies that Sean talked about. There's fiduciary that's important, and then there's the property, the general liability, all of the other normal insurances that you would purchase. But for cyber specifically, really a cyber policy.
Great, thank you, Zach. What are the advantages or disadvantages of pooling pension systems' insurance purchasing power?
So a lot of times, I know something NCPERS has done, pooling them all as going to one insurance company or multiple insurance companies to say, hey, these are all similar risks, to get more of a pre-agreed pricing. So that's the benefits. The downsides of that, as long as they're written on separate policies, there's not much of an issue. If they were looking at creating like a pooled policy with multiple plans, then you would all share one limit, and each pension plan could erode each other's limits if there was a breach. Where one, if they were together, one may be left without coverage if there was a large loss.
Great, thank you, Zach. And then this last one, I think, is for you, Sean. In terms of the Identity Guard insurance, you did mention the $5 million insurance.
Yes.
Tease that out a little bit, and also relative to the recent PBI breach in the public sector, and the exposure that a number of plans have experienced due to that. Again, can you tease out the difference between what a typical sort of identity monitoring is versus the identity insurance that is Identity Guard?
You bet. So, typically when there's a breach, there's a requirement underneath HIPAA or underneath the Gramm-Leach Bliley, depending on what kind of a breach it is, whether it's financial or whether or not it's underneath insurance. They'll go out and actually buy some credit monitoring, and that's usually through a Transamerica, an Equifax, somebody like that. And the way that works, anybody that taps your credit for a credit inquiry, it will send you a monitor or an alert. So if somebody goes out and tries to open up a store credit card, like somebody goes to Kohl's or maybe somebody goes to whatever place that's out there. I don't know, Bass Pro Shop. I don't know where you get a particular credit card, but you get a credit card from one of these places, or maybe you just file for a bank credit card. They're going to tap the credit agencies to see what your credit score is. It's going to send you an alert and say, okay, hey, did you do this, Hank? And you can say yes, or you could say no. And if it's no, then obviously there's a problem. You've been alerted. So that's the monitoring aspect of it. The actual insurance piece of it is much more robust. Somebody's gotten a hold of, let's say, for example, they've gotten a hold of Hank's identity. They've gone out and they've opened up a bunch of credit cards in your name, or maybe transferred a title, or maybe even tapped into your retirement accounts, bank accounts, whatever that may be. The insurance will actually step in and really do three key things. Number one, it's going to see how far that breach goes and spend monies to get it away from them, and say, hey, financial institution, insurance company, etc., people that reached out to you and said that they were Hank aren't really Hank. They're somebody else. They're Zach. I'm looking at Zach in that Brady Bunch window here. So the expenses associated with that. If there's any legal fees, court documents, etc., that need to be filed on Hank's behalf, it'll pay for those as well. And then the second leg of it is it'll actually go in and restore any monies or any amounts that you're out of pocket because somebody had gotten into maybe your retirement account, your bank account, etc. So it'll actually restore you in that aspect. And then the third kind of leg of the stool that's out there is anything that you've got to do in terms of your lost time at work. So you may have to go to court. You may have to spend a lot of time away from your office to actually get your credit back. And we had a young lady in our office back a few years ago, and Hank, I won't share the name, but you actually know who it is. That had to spend umpteen number of hours outside the office, just going to all these various places, and was away from the office and exhausted all of her PTO, exhausted all the leave that was available to her. So now we're getting into unpaid leave, things of that nature. So we'll actually pay for that as well. So those are kind of the three-legged stools, or the three-legged stool, if you will, of the various things that the insurance can actually pay for.
Great, thank you. We got two additional questions. First is, as far as backups, what is the latest solutions everybody is using? Disk to tape, replication, and or the cloud?
I'll take that one. And right now, most people are using cloud backups. Cloud backups are usually the easiest, and also they have replication. You can set it as 24 hours, 36 hours. It's the easiest. We see a lot of just offsite. We see a lot of Veeam. Veeam is a vendor that is used a lot. But ultimately, if you do backup and use an offsite vendor, if that vendor has a breach when they want it, you are still responsible to notify your constituents because you gave that vendor the information.
Great. And then the last question before we leave is, anybody using AI at pension systems? And I'm assuming it has to do relative to digging out fraud or scams. Zach, any thoughts about AI?
I haven't seen it too much, but it depends. Like you said, Hank, it depends on how they're using it. We're seeing everybody use ChatGPT. So if they're using that as just a tool to help, or if they're actually using AI for other things, it just kind of depends what they're doing.
Okay. Well, we are at the top of the hour. I want to thank both Sean and Zach for joining us today. I also want to thank everybody who attended. A lot of information was covered. So we will have a recording of this session as well as on our website. If you go there at NCPERS, ncpers.org, along the top navigation, there is a link for affinity programs where you can get more detailed information. Lastly, our next webinar is scheduled for October 17th, and we will be discussing our soon-to-be published 2023 compensation survey of public employee retirement system staff. Thank you, everybody. Thanks, Zach. Thanks, Sean.
Thank you.
Thanks.
Bye.